Hi, this is Anthony, parent of IRS Medic, and today I have a fantastic guest for you today. It's Dawn Polin.
Polin, yeah,
Polin,
either.
and she is from qualitycostseg.com. Thanks for joining us so much today. I ran into Dawn because I had a little issue with an international client, and she just happened to put up a CLE. And so I registered for it and really helped me out, really clarified a bunch of things. So she really knows what she's doing. And really helping a lot of people out. And I had a tricky situation, which we'll talk about a little bit later. But Dawn, I want to get into the biggest question right now. Why international real estate? Why invest in real estate? And why international real estate? What would you say would be the biggest reasons why?
Well, real estate in general, and when you're investing, when you get to the place in your life where you have money to invest, you're either going to go towards the stock market or you're going to go towards the real estate market. And if you really want to diversify, you'll do a little of both. Once you invest in real estate, in general, you have the income stream that comes off of that. And then you also have the appreciation and value of the actual real estate itself when you sell. So when you're looking for opportunities of where to put your money, it's different than when you're investing with a brokerage house and you're just buying stocks, or you might have a broker that's helping you with that. When you're investing in real estate, it's a lot more personal. You're going to go out and pick your own properties. You're going to find your own deals. So a lot of people look to international sources to buy real estate and get that same income stream. The concept is exactly the same. A lot of people have a background or maybe family in other countries, or they love to visit another country, and so they want to buy property there. So it's just a natural sort of evolution of a lot of places where people are putting their money these days.
Yeah, you know what? And I would say this: people ask me, "Hey, Anthony, save me some money on my taxes." They're just asking me to take my magic wand. I was like, "Well, okay, well, we kind of need three things here if we want to do that. If you have a lot of assets already, if you're already wealthy, actually, it's very easy to come up with fantastic tax saving strategies. And then the other thing, too, is either real estate or a business, and real estate's kind of a business, so it's there. That's when tax saving strategies actually come into play. And it's actually hard to kind of build a portfolio without some tax advantage structure. It's incredibly hard because your corpus is attacked every year by the government taking its fair share of whatever that is exactly. So that's what I say to people. It's like, well, look, do you have a business? No? Okay, well, then you got to find some real, or do you have a business, or are you already wealthy? No. Okay, well, then real estate might really be something to look at. Now, so one of the problems now, though, and I would say this is when we look to the United States to invest, that's sort of one of the problems. Is there's mostly everything is kind of played out, especially in Florida. It's kind of hard. Florida's a big place where it's played out. I mean, it's hard to get in.
Yeah, there's a couple of problems. So it's hard to get in, especially, I mean, these last few years, we've seen real estate prices really rise. So it's a little bit harder. You've probably heard of people talking about their cap rate, to really buy a property for an inflated value and then get the income stream off of it that really makes it worth their while. You've got to run your numbers. And one of the things is when we're going to talk about, depreciation, when you have an area, and we'll just pick on Miami, that really thinks that you're buying a house. Yeah, there's a house there, but you're really buying the land, and land's not depreciable. And there's a lot of play and a lot of interplay between a jurisdiction saying, hey, this is 90% land, which means you're never going to get a depreciation expense from that. And I would argue it costs a lot of money to put a structure on a property. So are you trying to tell me that this house is only worth $50,000? That happens. So especially when you're looking at beachfront property, when you're definitely looking in New York City, when you're definitely looking in Miami, you've got a heavy-handed land allocation that you have to be really careful about. And that's a big gray area in the tax law as to what that is, but it is the absolute first thing the IRS will look at if they audit you, is your land allocation.
Oh my God, I didn't even think about that. That is a huge point. That is an utterly huge point. And and really when you're buying, and because, really what you're trying to do, and as we'll discuss further, is you're trying to recapture some of your investment as quick as you can, offset it against your income to lower your taxes.
Right.
But in that case, no, you're in that situation, that beautiful beachfront property is worth a lot. The property is the building
Mhm.
unfortunately. And so that's really where your savings comes up, is in the
Mhm.
buildup of
Right.
whatever you're doing. So wow, I
Mhm.
never thought about
Mhm.
that. So any other, so New York, oh, okay, because even though you have your skyscraper, they're still saying, well, according to this portion of land that this we're going to allocate to that your building here is
Yeah.
so significantly large in
Yeah.
relationship to what your build out is. Oh wow, that is
Mhm.
something to look
Mhm.
out for.
Yeah,
Hmm.
with the skyscrapers, and this is the same thing with the big condos in Miami too. It gets confusing as to whether your ownership is actually in just your unit or you actually own a portion of the land that the so it's dicey, but
Wow.
it's you have to just be a little bit careful. You have to consider that for sure. So if you're considering, like I had a client recently who wanted to buy a property and she wanted to do cost segregation to offset in her taxes to cover her down payment for the property. So this was in her mind what she needed to do cash flow wise. And that's tough. You've got to really be careful. You can do that, but you have to be buying the right property and you have to make sure the land allocation isn't too big and you've got to make sure you've got the right assets. And so, these are the kind of things that are driving the investments right now.
Wow. So yeah, so one of the things that you're looking for in this entire calculus too is
Mhm.
where land is relatively cheap and you can build a little bit more. Where you
Right.
can build
And
out
you
a
also want
bunch.
people to rent, where you
Yeah.
also going to have renters.
Yeah.
So, I mean, I have,
Yeah. Maybe that's why people are going to the market. Like, okay, yeah, I want to get yeah. So it
yeah,
takes a little bit. You really
yeah,
have to be you really have to be somewhat sophisticated to start looking into this. It really has to be something you're passionate about.
yeah.
So we talked about cost segregation, something that you and I know, and something maybe a lot of our viewers do know.
Mhm.
But why don't we just throw what I call cost segregation is a way to, and I sort of murder it because I'm combining two things in here. It's a way to accelerate your depreciation into a quicker
Mhm.
amount of time, which
Mhm.
I'm combining terms of art. So maybe you could articulate
Mhm.
that
Mhm.
a little bit better for me.
It is a way to accelerate your depreciation. The IRS requires you to depreciate real property, which is real estate, over a very long period of time. So, as we all know, with inflation, a future deduction is going to be worth less because just inflation is going to eat away at that, and you've got that time value of money concept. So, a cost segregation allows you to basically segregate what's considered one asset to the IRS and put a portion of it in personal property or a portion of it in land improvements, which brings it out of the real property bucket. And then when you do that, you can depreciate it essentially now or mostly now within the next 5 years. Let's say, there's other kind of levers that get pulled, but it can largely save you tax dollars right now. That the idea is that you can reinvest that into your property, or that can help you with your down payment to buy the property and to get into an investment that may be a little bit bigger, all of those kind of things. It's definitely a cash flow planning technique.
Yeah, absolutely. Yeah, and as the one you helped me out with worked out really well. We got because of our depreciation, because of understanding the rules, my client was able to get in a much. He did not miss out on this opportunity that he saw, that he's incredibly fired up about, and it all worked out by getting the right advice.
I
Now,
love
now there is something called bonus depreciation
it.
that comes
Hmm.
into play with U.S.
Yeah.
property.
Yeah.
So, what's bonus depreciation?
So bonus depreciation is so when you think about all tax incentives, Congress gives us tax incentives to be able to drive the economy where they want the economy to go. So when you look at everything, when you look at R&D credits, they're wanting certain actions out of their taxpayers. So
Mm.
cost segregation itself is not actually given to us by Congress. It's actually just the rules of how they've played out in the courts for people going to the courts and
Oh
saying a portion
wow!
of my building is personal property. So it's actually not an incentive given to us by
Oh,
IRS, just cost segregation itself. Yeah, just allowing, it's actually all born out of the court system. So that's that third level that you learn about in law school, for how laws are made. Um, but bonus, however, is an additional lever that Congress gives us on top of that. So what it means is when you can put something into a shorter class life, basically with a class life of 20 years or less, which is your 5 year, your personal property, your 15 year, your land improvements. So not what's remaining in your building the
And
20
just to clarify, when
remaining.
we're talking personal
Mhm.
property, we're kind of using it as a term of art. We actually, it's a term of
It's
art of a tax treatment. It's not
it's
necessarily your handbag or anything
Yeah,
like that.
exactly. But it could be. It's personal property is basically something that's usually mobile. It's desks and lamps and all these types of things if they're used in your business. So all depreciable assets have to be used for an income producing activity in a business setting. So you do have that. So when you buy a computer in your business and you're allowed to expense it or depreciate it, that's the same thing. So you're actually pulling out a portion of your building and calling it non-real estate. It's more personal property, which it falls into this bucket. There's only two types of depreciable assets: personal property and real property. So once the IRS, so this is the reason why bonus depreciation rules are used always with cost seg, is you can't tap into the bonus rules until you do a cost seg, because until you bring a portion of your property into these shorter class lives, then the IRS says, well, this year, this like 2023, we're going to allow you to anything put into a shorter class life bucket, less than 20 years, we're going to let you expense it all in year one. So forget about the fact that you're supposed to depreciate it over 5 years or 15 years. We're going to let you depreciate it all in the first year. So last year for 2022 was the last year we had 100%, which means
Okay.
100% of those numbers that go into those buckets expensed in year one. So it's
Wow.
a huge pop. What happened was roughly 25% of most buildings, when they do a cost study, the cost of them, boom, gets depreciated and expensed in year one. So it's a huge windfall. This year, it's an 80% bonus rule,
Okay.
which means 80% of that cost. So if you move $100,000 into a 5-year life, $80,000 can be boom expensed in year one. The remaining 20,000, the remaining 20%, now just has to live over the 5-year life,
Okay.
which was the standard. That's the beginning step. So we had many years where we had a 50% bonus year. So 50% expensed accelerated in year one, and then the remaining 50% is depreciated over 5 years or 15 years or 9 years, whatever the life is. There's a couple other things too, because depreciation, we actually have double declining balance. Even your 5-year life is front loaded in the first couple of years, which means because of half year, you get 20% in year one, 40% in year two, and then it goes down from there. So it's interesting the way it works, because it's still, even without bonus, it's nice. So we'll talk about that a little bit more with
Yeah, we're going to
international
have to talk
properties.
about that.
Yeah,
That's mandatory for
yeah,
where we're headed next, right?
yeah.
So we want to talk about you. So and here's so domestic property, because hey, as you said, Congress is directing the activity
Hmm.
that they want out of
Hmm.
taxpayers, and hey, we want to. And this is most of the content I talk about my channel is how the tax rules punish in foreign investments. How they're
Hmm.
many times by
Hmm.
design. And many times the
Hmm.
rules and their
Hmm.
interpretations attempt to punish it. So here we kind of see the same thing, because while
Hmm.
bonus depreciation is allowed for U.S. property,
Hmm.
it's not allowed for international, though, right?
It's not allowed for international. And that is because you have, for the maker's depreciation system, which is what it's called, there's a general system, which is for US, anything, all of US property.
Hmm.
And you have to use an alternative system, the alternative maker system, under if you're foreign. Now, this applies to any foreign. So if you have a manufacturing facility, all of your assets in that manufacturing facility that's in another country, offshore, all of that has to go to the ADS system. Any foreign property that's reported on a US tax return that's placed in service in a foreign country has to be depreciated under the alternative system. And magically, the alternative system is not allowed to take any bonus.
Wow, imagine that! Imagine that! Could you believe that? The
Mhm.
United States government is kind enough to be the only government in the world that truly taxes its citizens around the world on their income, and they're so gracious to give more punitive rules. This is really a foundation of a lot of our content about these differences and how to still take advantage of investments, but just being aware of, hey, look, you're really stepping into to an area that most tax professionals might not be comfortable with, and might not understand it. Maybe that's where we should talk about next, because I just got a new client who came in to say, hey, look, I'm looking to save some money on taxes. He is an airline pilot, and he's been investing in real estate and living in various places. And the first thing that I came across as I was reviewing his return, and he was not happy about this. He was not happy at all because he was like, "Hey, what can you do to save you money?" And I said, "Well, actually, what you have here is you have a Costa Rican company that you're investing, your real estate." And I said, "That has limited liability, doesn't it?" He goes, "Oh yeah, it does." I said, "Right, it doesn't go on a Schedule C. You are missing a foreign reporting form where it actually has to go because the tax code in its infinite wisdom decides to create onerous obligations with significant penalties for not reporting." So I said, right now you have kind of at least, you have a $10,000 penalty exposure for every year you've owned this property. So that we can deal with it and we can handle it. But that's not really what he wanted to hear. So I'm sure you encounter that too when you're helping people out, when you're saying, "Wait a second, I know you want to start saving," but is that something that you happen to see as you're going through these things?
Yeah, I think that what people need to know is, as the rules for taxes are getting more deep and wide, just harder every year, and they're making changes mid-year, and there's just a lot going on, they need to think about CPAs and their tax accountants the same way they do their doctor. So you have a general doctor who just knows certain general things about how to treat a cold or something like that. But when you have a real specific problem, you have to go to a specialist. And you see this in law. You see a lot of lawyers specialize in certain areas, but you don't see that as often with CPAs. But I think that's the way it's going. A generalist in the CPA and the tax accounting world, enrolled agents, they are just that. They're generalists. So unless they have a lot of clients in a certain area, they have not seen many things, including myself. This is one reason why I like to stay in one area, because I can be very deep in my knowledge in that area. But don't ask me about, and I will tell you from a preparer standpoint, the $10,000 penalty told me right away I didn't want to do anything international.
Yeah.
So a lot of people stay away from that.
And that's right. And I would say this too, is as they train everybody and all the tests, all the enrolled agent tests, all the CPA tests, they're all sort of training you for like an average business, whatever an average business is. And so, what it comes down to is, okay, someone in your town who has a brick and mortar business, they're a generalist will generally be pretty good at the general idea. But,
Right.
we're seeing so many people don't have that brick and mortar. So many, as we see the, economy and different ideas coming up, a lot of virtual businesses too, sort of that can be anywhere.
Yeah.
So yeah, that is, I would say, yeah, that's a recommendation for any generalist, is you might want to specialize a little bit more, because
Yeah, I'm seeing a lot of CPAs specializing. One of the biggest needs, I think, right now are CPAs, and they are out there, that specialize like in for the virtual currency. That's totally different.
Yep.
And then also just even the marijuana that's being legalized in different places. So there are firms that specialize in that. The rules are completely different. So think about those things when you're talking to your tax accountant. You might not have ever thought to ask really what they specialize in. But a lot of CPAs now are advertising, saying, "Look, I really just do these businesses," and then they can do those really, really well. But a lot of people don't realize that they don't. Their CPA does not know everything.
Yeah, right. That's right. There's too much to know. And I've been doing this for 20 years, and every day I learn something big that I feel like I really should have known that. Why didn't I know that? It's just,
I stopped beating myself up about that.
Yeah.
I think especially when you're young, you think you should know everything, but then I just realized, it really is. You have to know where to go. You have to know who to ask, and that's the key.
And your thought process, that's really what I think people are looking for. Hey, look, how do you handle a situation when you don't know the answer?
Right.
Right. That's what I go see. Now, one great strategy that works, and I love this, is you purchase a property, cost seg it, get whatever you can off, and now what you're doing is you're reducing the basis in the property.
Yeah.
So that can create a problem when you go to sell that property, because you could have a huge gain. And so what did you really accomplish? But is there a little trick that's out there? Is there a little trick out there?
Well, it's I wouldn't call it a trick, but you do have a rate play, because what happens is when you buy a rental real estate or commercial real estate property, you've got the income stream coming off of that. And that's ordinary income. So that's taxed at your highest rate.
Okay.
And you've got your depreciation expense that's reducing that highest rate. So let's say you're in the 40%, 35% tax bracket. When you sell your property, now that's reducing your bases, and this is required. You can't get out of it. You have to be reducing your bases, whether you took that depreciation or not.
Right. It's use it or lose it. And
It's
that's,
use it or lose it.
Yeah.
So you don't have a choice on that, but it does behoove you to do it. So when you sell that, that's a capital gain. That's different because that's now an investment property, and the capital gain rates are 20%. So that's a rate play right there. So you got a 35% benefit, and you had the gain at 20% and later. And I know, you do a lot of 1031 exchanges. You can get out of that with the 1031 exchange. I know you're going to talk about that, but there's definitely a rate
even
play
without
there.
a 1031, and that's what, we'll talk about that in a second, but even without a 1031, you say, hey, wait a second, it's still a good idea because we're converting ordinary taxes into capital gains. And actually, this is kind of crazy. And this is one of the things that I didn't realize quite until earlier this year. That seemed kind of big. I was looking at the tax brackets. Like, wait a second. If you're a married couple and your only income over the entire year is from a long-term capital gain, you could have up to $83,400 in long-term capital gain before you owe any taxes. You don't owe any taxes. And we get kind of confused because the ordinary, that's all the ordinary rates for your regular wages. That's typically what people think of their tax brackets, but we have several different tax brackets depending on what kind of income it is. So long-term capital gain is quite better. And if that's all you have, I mean, it really might wake up that you might do well on that. So, okay, I'm glad you mentioned that before I jumped into 1031 exchanges. Thank you for your thoroughness on that, because that's absolutely true. But now let's talk about that. Let's talk about a 1031 exchange. Let's say I have, one property, I have a great offer on it, and I kind of want to get out of it. And my basis is I've really depreciated a lot. It's going to be a big gain, and I kind of don't want that to happen. What is a 1031? How does it work?
So 1031 is a rule that the IRS gives us, that has been around for a very long time, that allows you to exchange properties and defer the gain. So basically you're just rolling that gain into your new property. So it's just allowing you to replace one property with another. You're still being invested in real estate. So if you want to get out of real estate, then you're going to have to pay that gain, but you can just push this forward. And then really the long-term play for real estate is with, I call it the swap till you drop, or everyone calls it the swap till you drop. If you can hold on to that property and live on the income, then it can go to your heirs tax-free. So you can escape that capital gain permanently if you hold it long enough.
So now here's a question for you. I don't know if you know this one. So, you have this, because what happens is when you pass, you get the stepped up basis of the fair market value of the property of the day of acquisition.
Yes.
So what my question is going to be. I want cost seg on that as the heir. Can we do that?
100% you can do that. Yes. Yes.
All right.
So in the hands of the heir. So let's just say, I like to throw numbers to things. You had a property that you paid $2 million for. You owned it for 40, 50 years. It was fully depreciated, had a zero basis. So now it's worth $10 million. So you get a step up, $10 million to your heirs. That's their basis. Now, there's rules for estate planning. They may have had to pay tax on a portion of that, but in their hands now, that is worth $10 million, and it restarts depreciation as of the day that, their parent passed. That's their step up date. So it gets rebooked on the depreciation schedule and starts depreciation over, which allows you to do a cost seg. It's the same. It's a real estate asset.
Wow. Now, so now some general rules of thumb. Let's say I do have a $10 million, say, apartment building. And let's just say normal average, it's not, I'm not in a jurisdiction where the land allocation is going to be that heavy. I have a $10 million property, maybe the land is worth $500 or $1 million, something like that. Okay. What would be and assuming because this is something we'll have to discuss too, assuming that this passive income, if it's generated passive income, that the cost segregation losses that it could create, what kind of net result would it be to my tax bill?
Well, you stepped into the passive, the active, so that's
Yeah,
a
I
good
guess I
thing.
did that. And
You really did that. And so that's where it
yeah,
gets a little bit. So when I'm working with clients, and I also work with their current accountants, and so I ask about that because it does depend. So if it's a passive income, which real estate is passive by nature, unless you can prove that you're a real estate professional, or if it's a short-term Airbnb, it's treated more like a hotel, which is active. But anyway, otherwise it's passive. So it's really, your loss is going to be trapped in that passive side. Now, what a lot of people don't know is, let's say you have 5 investments and you just cost seg one, they're all passive. They're all in that same bucket. So the loss from one can cover the income from all 5 of those because they're all on that side. So just think of it as 2 sides of the fence. When you've got the active side and you've got the passive side. So they all play together on their side of the fence. So that's really what would happen. If you do not have enough income to absorb that loss, it will carry forward just like any operating loss carries forward into future years and will offset future income.
but if it is active, then it could
offset W-2 income. This is definitely a strategy. People, if you have maybe one spouse that stays at home or doesn't work and one spouse that makes a lot of money, and then you start investing in real estate and they're managing all of your real estate assets, and it is a lot of work, then you could be considered a real estate professional. And now you can hop on the other side of the fence with your income and offset W-2 wages. That's what's on active side.
that's so okay. So let's assume that we could do that. Let's assume that we're a real estate professional. And let's say that I inherited, $10 million property, and I have a big tax bill. What do you think cost segre would do for first year? And assume it's, I guess we'd have to assume it's in the US because we have bonus depreciation, or I guess 2 different answers. You know what? Why don't we say one property was in the US, one's overseas? What do you think the savings that would I could sort of foresee the first few years of this?
Okay, so if you have, let's just say it's 11 million because we'll take out the 1 million for land.
Okay, yeah, good. All right, let me
so we can use 10 million for our depreciable. It's a little bit easier.
Yeah.
So if it's an apartment complex, they get a great breakout. So I would say 3 million of that can be brought into a shorter tax life. Okay, so then you could bonus 80% of that in the US in year 1. So now you're gonna keep 2.5-ish. 2.5 is 2.6, 2.4. 2.4 million would be your first year depreciation expense, and then the remaining 600,000 would be accelerated, from that over the 5 or the 15 years in the first part of the life of that building. But now that's with bonus and that's with the lives. So what I didn't mention was when you're foreign, you have generally for US, you've got 5-year, 7-year, 15-year. Those are your shorter buckets. When you go to the ADS system, not only are you not allowed bonus, but your lives are stretched a little bit. So you've got now 9-year, 20-year, and then you've got 40-year or 30-year if it's residential. So if you take a 39-year commercial property under the regular system in the US and 40 years under ADS, that's only 1 year difference. That's non-impact. Sort of same thing with residence. You have an apartment building, it's 27.5 years, and then it goes to 30 years for ADS. So that's just your straight line piece. So, and that's not a huge benefit, huge difference either. 2.5 years is still a long, long time. But when you go to 5 years to 9 years or 15 years to 20 years, you're stretching it out a little bit more. You are not allowed to have any bonus. So you are still, though, pushing forward. You're depreciating your land improvements in half the time now, and you are depreciating your personal property in a third of the time, roughly. So we have models for all this. And what I tell people is it's easiest to throw it in the model. It calculates all of your specific numbers and your time value of money and applies the factors to it. And then you can just see. I let the numbers speak for themselves.
Now, is this something, because you offer a free consultation to people, is that correct? Okay,
Yep.
so is this something that you offer?
Yep. We will do that for free. We will do that for free because you will not know whether it behooves you to do this or not until you see the numbers. And so we would never want you to just guess and go forward with something that wasn't going to work for you. We want to be able to weed out those properties that it doesn't make sense. Like we do not want unhappy customers. So yes, we will look at that for free.
Well, that brings me to your advice. You really helped me make sure to avoid a problem with my client because we had a timing issue. We were looking to offset. We were looking to offset because this is going to be a short-term rental that will go against his ordinary income.
Mhm.
Okay, so good there. But he's like, hey, look, I really need to write this off, because I got estimated taxes to pay. And I tried, and during your presentation, you said, well, there's a developer strategy that you might be able to work, and I tried to do that. I talked to you about that. You're like, well, actually, that's not going to work because you have to place it in service. Is basically
Yeah.
what you concluded. I was like, oh, okay,
Yeah.
no matter what. So what I
Yeah.
was able to advise my client on is like, okay, here's the thing. We're not going to get any deduction until that's placed in service. And
Mhm.
so that's the critical date. Whatever we're trying to do, we're not going to get anything here. And we were really concerned about the timing on this because he had a tax bill. His tax bills were due. He's like, but I need this now. I need this now. Well, come to find out, and he forgot about this because in his head, he thought he was short. But because we started some tax planning on other things, he
Mhm.
actually was in fine shape. He goes, oh, wait, I have $100,000 to pay forward to next year. So like, okay.
Mhm.
So
Sure.
now he knows like the timing of it is absolutely critical. And I just want to thank you for your help on
You're
that. It
welcome.
really got him through the right way. So that was, I think, now he's invested in a great project overseas. And he understands that, and it is going to be a short-term rental, and so it is like the hotel, which is sort of, and this is sort of the trade-off. Well, if it's a short-term rental, it's a bad idea. Why is that? Well, because it's ordinary income and will be taxed at a higher rate. However, if you're able to get the depreciation, well, it's kind of better if you're not a real estate professional. If you're not a real estate professional, so um, if that's sort of all working out, the long-term rental can be a better benefit as long as you're having a loss, I suppose. But you got to be careful because while that could, like a short-term rental in the United States, could generate a quicker loss for you on your against your ordinary income, um, because it's stretched out overseas, it's not going to be as good. Uh, and that's something your analysis would show too.
Yeah, the analysis will show that. And it really all depends on how much you spent on the property, really. The more you spend, the more benefit you're gonna get just by nature of having spent more. So that is a lot of times the driving factor. Yeah.
Now, what if somebody's considering buying a property? They don't have it.
Mhm.
But they're thinking, hey,
Mhm.
I'm thinking about, I got this deal here. I want to invest somewhere.
Mhm.
Is that something you would help out, or do you look for just people who own property already, or would you
No,
give
we
them?
look at, if you're looking at a specific property, we usually have to look at the specific property because we take a look from Google Earth when we do the estimate for you to kind of give you an exact or more of an exact, it's still a range of what we think that property will yield. And the site plays a lot into that, and which we can see obviously from Google Earth. So, but if you are considering purchasing a property and you have an address, we can do it. And what you think you're going to pay for that, we can do that. And then when you actually buy it, we can adjust the estimate by what you actually paid. So it's very fluid. These are quick things for us to do.
What if you're building the property?
If you're building the property, then you usually have a budget, so we can go based on the budget. So
Okay.
my builder projects this to cost this amount, and then when you actually do the study, we use the exact amount. We have to wait for it to be finished, the numbers to roll in, and everything to finalize it. But we can give an estimate with a lot of ifs, ands, and buts in there, and then just
Okay.
revise. Yeah.
So if somebody's thinking about making a big, investment overseas or anywhere, really,
Mhm. Anywhere. Mhm.
say, hey, reach out to Dawn, and she could really
Mhm.
give you a great idea of what you're looking at, of
Mhm.
what the tax savings is, and really,
Mhm.
so that
Mhm.
you could, the idea here is that you're able to take advantage of an opportunity you wouldn't otherwise be able to do,
Right.
and
Right. Right.
really scale up,
Right.
by doing
Yeah.
that, by getting, when that money doesn't have to go to the IRS, but actually is something you're able
Yeah.
to leverage and invest
Yeah.
off of. That's
That's the key.
significant. Yeah. Oh boy, that's key. I want to thank you. Anything else you want to add? I think we discussed so many great things. I have a lot of, and I've learned even more. I've learned a few big things today. I really appreciate that. Anything else you want to discuss? Anything else that anything people should be concerned about, worried about? Anything coming up on the horizon?
No, no, I would just encourage people to reach out and ask their questions because what I have found is you can find a lot of knowledge out there on the internet and watching presentations like this, a lot of knowledge. But when it comes down to your specific situation, there is nothing like specific advice. And it's just absolutely amazing. And like you, I have seen, there'll be something that comes up and I'm like, oh, wow, in my, 10 or 12 years of doing this, I did tax returns for 25 years before this. I haven't seen this situation. So it's just always great to walk through a specific scenario. So there's nothing that replaces that.
That's incredibly valuable. I think you're absolutely right. Dawn, I want to thank you so much. You've helped me already this year, and you're helping so many more people. Really, you got a great service you're doing there that can really truly help people out. And I mean, it's awful when I run into it and I see the disasters people get into and not knowing, not because they didn't get the right advice. And you're out there, your company's giving great advice there, and it's a free consultation. You got nothing to lose to get some really good ideas whether or not you should make that investment.
I agree. I love all of it. Thank you so much for having me on today, Anthony.
You bet. All right, great. Well, this is Anthony Parent for Dawn Polin. I keep on saying that wrong, or no, right? Polin.
That's right. That's right.
I did get it. Okay, I got it right. Yeah, sorry. This is Anthony Parent of Iris Medic. Thanks for watching.